Hello friends, in this lecture we are going to deal with derecognition of a property, plant and equipment when we are going to remove it from our books of accounts. We are continuing with Indas 16, when to derecognize an asset from our books of account, how to determine gain or loss, what are the disclosure requirements, how to deal with government grants related to property, plant and equipment is what we are going to discuss in this standard. Okay, so let us go ahead with derecognition. When can I remove an item of property, plant and equipment from my books of account? The standard says the carrying amount should be derecognized either on disposal, that means I have sold away the asset, on that date I can derecognize it, or when no future economic benefits are expected from its use or disposal. I know that if I use the asset I am not going to get any benefits, or even if I dispose it I am not going to get any benefit. In that case as well I can derecognize the asset from my books of account. So on disposal, or when I expect no future economic benefits either by using it or by disposing it, in such cases I can derecognize the property, plant and equipment from my books of account. Next, how to deal with gain or loss. Suppose I have disposed of property, plant and equipment. How to deal with gain or loss? The standard says first of all find out the difference between the carrying amount, that is the WDV of the asset, with the net sale proceeds. See, why I am saying net sale proceeds is when you dispose of property, plant and equipment, at the time of disposal you would have to incur some disposal cost. So sale price minus disposal cost will give you net disposal proceeds. Compare it with carrying amount. If net disposal proceeds is more than the carrying amount, then you get a gain. That gain or loss should be recognized in the profit and loss account immediately. There cannot be any deferment, there cannot be any delay. But in the case of Indas 17, when you have sold an asset and you have again taken it back on finance lease, in such case, such gain or loss would be amortized over the lease period in the proportion of depreciation charged on that asset. But this is a prescription of Indas 17, not as per Indas 16. So as per Indas 16, on disposal of an asset, any gain or loss should be immediately recognized in profit and loss account. But if the asset has been sold and again it has been taken back on finance lease, as per Indas 17, the gain or loss cannot be recognized immediately. It has to be amortized over the lease period. That is a specific requirement of Indas 17, not as per Indas 16. And the profit or loss is not going to be recognized as revenue. You can show it under other income. Okay. Next, we come to the disclosure part of the standard. Let us see what the standard has to say about the disclosures. Let us see the disclosures as required by Indas 16. Let us go to the disclosure requirements. The first disclosure requirement is the financial statement should disclose for each class of property, plant and equipment the measurement basis used for determining the gross carrying amount. So whether the gross carrying amount is based on cost or is it based on fair value, that is revaluation model, which measurement basis are you using for calculating the gross carrying amount? That is what we have to first disclose. So company has to describe whether it is following the cost model or whether it is following the revaluation model for arriving at the gross carrying amount. Then second, depreciation methods used. Which method of depreciation are you using? Are you using SLM method? Are you using WDV method? Are you using production units method? Which method are you using? Sum of digits method? Which method are you using has to be disclosed. Next, the useful life and the depreciation rates used. What is the estimated useful life the company is using? You can take an indication from schedule 2. Depreciation rates used. What is the rate of depreciation you are using for depreciating the asset has to be disclosed. The gross carrying amount, accumulated depreciation, aggregated with accumulated impairment loss at the beginning and at the end of the period. So we have to disclose at the beginning of the year what was the gross carrying amount, accumulated depreciation, accumulated impairment loss at the beginning of the year, gross carrying amount at the end of the year, accumulated depreciation and accumulated impairment loss at the end of the year. Then we have to give a reconciliation of carrying amount at the beginning and at the end of the period. See here, carrying amount means WDV. What was the WDV at the beginning of the year? What is the WDV at the end of the year? The WDV at the beginning, WDV at the end may not be the same, because there might have been some additions to the asset which might have taken place during the year. There might be some disposals. You would have sold some assets because of which the WDV is going to reduce. There can be depreciation charge during the year, impairment losses, reversal of impairment losses during the year. Foreign exchange differences also can be a factor for difference between the opening carrying amount and the closing carrying amount at the end of the year. So you can see you have to show the additions, you have to show a reconciliation. Assets classified as held for sale, acquisition through business combinations. So if you have acquired some business during the year, their assets would also be incorporated in your books of account, because of which the closing carrying amount will not be equal to the opening carrying amount. Then increase and decreases resulting from revaluations, impairment losses, reversal of impairment losses, depreciation for the year, the net exchange difference arising on translation of financial statements. See, suppose you have a subsidiary at the end of last year. The fixed asset of the subsidiary would have been, suppose you have a subsidiary who is doing business in a foreign country and their balance sheet is prepared in dollars. At the end of last year, the assets of that subsidiary would have been incorporated in your books for consolidation purpose using the closing rate prevailing at the end of last year. Now the same assets in the current year at the end of the year would be converted using a different exchange rate. So there can be some exchange fluctuation which also have to be shown as part of reconciliation. Other changes. Then para 74, the financial statement should also disclose existence of the amounts of restriction on title and property, plant and equipment pledged as securities for liability. If you have taken a loan and you have pledged PPE as security, those items have to be disclosed. The amount of expenditure recognized in the carrying amount for assets under progress, that means assets under construction. So if there is an asset under construction, you are self-constructing an asset. Whatever expenditure you incurred during the year for construction, that has to be disclosed. Then amount of contractual commitments for acquisition of PPE. You have entered into a contract to acquire plant and equipment. So that contract also, the details of those contracts also have to be disclosed. If it is not disclosed separately in the statement of P&L, the amount of compensation from third parties for item of property, plant and equipment that were impaired, lost or given up, that is included in profit and loss account. Sometimes a third party may agree to reimburse you the loss because of impairment. You have lost an asset, you have given up an asset, a third party may agree to reimburse some amount to you. So the amount which is receivable, if it is not shown in the P&L account, it should be disclosed as part of notes to accounts. Then selection of the depreciation method, estimation of useful lives are matters of judgment. So how you have selected the method of depreciation, how you have estimated the useful life, these items have to be we can say disclosed as part of your notes to account, so that the users are able to use this information for comparing your method, your estimates with other companies as well. So you have to give more information about how you have selected the method, how you have estimated the useful life, so that the users are able to compare financial statement of your company with other companies. Then accordance with Indas 8, if there is a change in estimate of residual value, if there is a change in estimates of cost of dismantling, removing, changes in estimates of useful life, debt methods, some more disclosure requirements are required as per Indas 8. Now para 77 is relevant with respect to assets where we have revalued the assets, the date on which we have done the revaluation. If we have used the services of an independent valuer, you have to disclose that fact. Then we have, for each revalued class of property, plant and equipment, the carrying amount that would have been recognized had the asset been carried under cost. This is an onerous requirement. So as per para 77E, if you have revalued the asset, you are also required to disclose what would have been the carrying amount of the asset if the cost model would have been adopted. That means the company would be required to maintain asset registers under both the revaluation model and the cost model. This disclosure requirement makes revaluation model onerous, because you have to not only show information based on revalued amount, you have to also show information based on cost model. Now, during the year, if there is any change in the revaluation surplus, what are the changes that have taken place in the revaluation surplus, that also has to be disclosed. Apart from that, para 79, some information may be useful for the users. If there is certain property, plant and equipment which is temporarily idle, what is the carrying amount of temporarily idle property, plant and equipment has to be disclosed. Then gross carrying amount of any fully depreciated property, plant and equipment that is still in use. That means you have a property, plant and equipment which is fully depreciated but it's still being used. What was the gross carrying amount? That is the historical cost has to be disclosed. Then carrying amount of property, plant and equipment retired from active use and not classified as held for sale. That means you have stopped using a property, plant and equipment and you are not holding it for sale. What is the carrying amount of such asset has to be disclosed. Then apart from that, when cost model is used, fair value of property, plant and equipment, when this is materially different from carrying amount. Suppose you are adopting cost model, but you know that the fair value of the asset when compared to the cost is very high or it is very low. When you know that there is a material difference between the fair value of the asset and the carrying amount under the cost model, you have to disclose the fair value of such assets. That means we are providing more and more relevant information to the users of financial statements. So these are the disclosure requirements as per the standard. Now let us go back to our PPT. Now let us come to treatment of government grant. As per para 28 of IAS 16, there was an option if you have received a government grant for acquiring a depreciable asset. Indas 16 does not permit subtracting that government grant from the cost of the asset. IAS 16, that is International Accounting Standard 16, still gives the option to companies to subtract such government grants from cost of the asset. See, when you receive a government grant for acquiring a depreciable asset, there are two options available actually. As per old AS 12, there were two options available. Either you can subtract it from cost of the asset and provide lower amount of depreciation over the useful life of the asset, or second was you show the asset at cost, you recognize this government grant as deferred income, and this was recognized in P&L account in the proportion of depreciation charged. So first method was subtract it from cost of the asset, provide lower amount of depreciation. The second method was you show the asset at cost, you recognize the government grant as deferred income, you show it as part of reserves and you amortize it gradually to P&L account in the proportion of depreciation charged. These were the two options available earlier, but as per Indas 16, the option to reduce the government grant from the cost of the asset has been removed, but this option is still available under International Accounting Standard 16. So we can see this can be a major difference between what IAS 16 and Indas 16 has to say about it. That means right now we have only one option available. We can set up the government grant as deferred income and amortize it gradually over the useful life of the asset in the proportion of depreciation charged. Now we come to the next issue. This is Appendix B, which has been attached to Indas 16, stripping cost incurred in production phase of a mine. Now what is this stripping cost? See, a mining company which is involved in the business of mining coal, mining iron ore, that means they take out coal, iron ore from earth. What they do is they incur some stripping costs. Now stripping costs can be divided into two parts: developmental stripping and stripping during the production phase. Now what is developmental stripping? I have explored for coal, I have explored for oil, I have explored for iron ore, and I have found that there is a deposit somewhere. Now to access that deposit of coal, access that deposit of iron ore, I have to remove overburden. It is found beneath the we can say the ground. I have to remove the earth, I have to remove trees, I have to remove boulders to get access to that ore. This is called as developmental stripping. The day I know that I can start extracting coal on a commercial basis, commercial viability is there. The day the coal mining is done on commercial basis, till that day whatever stripping cost is incurred is called as developmental stripping. It can be capitalized and amortized, depreciated using production of units method. Okay. Now the second question is stripping during production phase. Now commercial production, commercial extraction has already started. During the production phase you may again incur some stripping cost. That means you have to again remove some overburden. Now this cost is incurred for two purposes. One, during the stripping activity you may get some coal. Apart from that you may get some waste as well. Now the objective of this stripping activity during the production phase is to produce some coal, that is extract some coal, and also to get access to new deposits of coal. So in such cases what the standard says is, I will again repeat it, during production phase you are doing stripping activity, that means you are removing overburden. During this activity, you may find that when you are doing the stripping activity, you are removing overburden, you are getting some output of coal. Apart from that, you are also reaching nearer to previously unaccessed or previously unknown. Earlier we did not have access to a particular deposit of coal. We are reaching nearer to the deposit of coal. So in such cases, this stripping cost which is incurred in the production phase, it is for two purposes: to get some output of coal and also to get better access, improved access to new deposits of coal. In such cases, this production stripping cost has to be allocated. A part of it is inventoriable cost which is incurred to extract coal, which can be added to cost of coal which is extracted during that stripping activity, and the remaining cost has to be capitalized because this is giving you improved access or access to new deposits of coal. And once the access is achieved, this cost will be amortized over that using production of units method once you achieve access to that particular deposit of coal. I'll again repeat, during production phase you are incurring stripping activity, you are incurring stripping cost. The output is two things: one, you are getting some coal; second, you are getting improved access to new deposits of coal. So this cost has to be shared between what is the cost incurred to extract coal and what is the cost incurred to get improved access or to get access to new deposits of coal. Based on a production measure, based on technical evaluation, you have to share the cost between inventoriable cost, that means the cost which will be incurred in cost of coal extracted during the stripping phase, and the cost which is incurred to get improved access to the new deposits of coal. This, out of the total cost, the cost which is allocated to getting new access or improved access to new deposits of coal should be capitalized, and it should be depreciated or using the total amount of coal which is there, the new deposit, using production of units method. So this is what is dealt with Appendix B. We call it is based on IFRIC 20, which has been issued by the International Accounting Standards Board. Thanks a lot.